What's going on, everyone? Welcome back to our masterclass series. And in today's masterclass, we're going to be focusing in on hybrid underwriting. So hybrid transactions, another form of creative finance. So what is a hybrid transaction? Well, a hybrid transaction is when you have an existing encumbrance on the property, either an existing loan or an existing substantial lien. And then we're going to have a new note on seller finance terms as a secondary loan for the property, but that note is being created with the seller. So this is what we call a hybrid transaction, where we have an existing loan and then a new loan with the seller. And so in today's video, we're going to be doing a manual underwriting example for a hybrid transaction. So if you have a copy of your Jericho software, follow along with me as we go through the manual underwriting process. And if you don't have a copy, then you'll find a link in the video description below for you to check it out. So I'm going to minimize myself here on the screen, and I'm going to bring over the PropStream, because PropStream is essentially going to be our best friend. Pretty much, as a real estate investor, PropStream 100% is going to be your best friend. According to PropStream, we have a property here linked in Atlanta, Georgia. And this property is currently listed on the MLS for $372,000. Days on market is approximately 11, according to the database. If we head over to the mortgage and transaction history, we can see here that there's only one loan associated with this property with an estimated principal balance of $160,000. We have an estimated loan payment for $770,000, the estimated interest rate of 3.3%. And so we know immediately this property has equity. So when a property has equity, a substantial amount of equity, we're essentially going to be giving them a down payment at closing, same way that we would with a seller finance transaction. We're still going to give them a monthly payment, but it'll technically be substantially less just because we have to deal with another loan that's already associated with the property. And as the investor, we don't have any intentions of paying off that first position note. So we're going to continue to pay down the first position note, which is going to be here. This is going to be your first position note. And then we're going to create a new note with the seller for their remaining equity. So we're going to go through that type of underwriting process. Let's pull this property up on Zillow. And on Zillow, we can see here that the list price and the days on market is correct. So PropStream did a good job in terms of updating their database in regards to those variables. Let's take a quick look at the property photos to find out what the condition is like. And immediately I can see that the kitchen's a little outdated and that the property's going to more than likely need new paint and new carpet. But other than that, property looks like it's in pretty decent condition. It was built in 1974. It's a 4-bed, 3-bath, a pretty substantial amount of square footage as well. Let's take a look at the street view. And it looks like the property is in a very nice neighborhood. So that's good because that's going to make it easier for us as the investor to sell this property in the future. So we're going to exit out of the street view now. And if you noticed, Zillow did not assign a Zillow estimate for this property. So in our last masterclass, we did have a designated Zillow estimate or Zillow market value. But on this particular property, since the days on market is 10, it's a fairly new listing, we don't have a market value. So we're going to have to assign one. But because we are the investor, we're going to have to be buying properties below market value or at or below market value. And it's currently listed at $372. I don't feel this property is worth this amount. And we're certainly not going to be comping this out immediately as of right now, because that would be a waste of time in the underwriting process. What we want to do immediately is set an initial offer to the seller for both cash and creative finance. If they come back to us and tell us we're interested in either your cash or your creative finance offer, that is when we would go through the comps, look at the ARV, and make sure that this property is actually worth the amount that we think it is and what we're willing to pay for it based off of our initial underwriting with the seller. So that's how we're going to approach this property. That's how we should approach seller finance properties. That's how you should approach really every underwriting for a property. Give an initial offer to the seller, see what they have to say, follow up with them. If they're ready to move forward, if they truly are a motivated seller, that's when you would have a final underwriting for the property. and verify that all your numerical values are aligned and that you as the investor or as the wholesaler can make a profit. So because this property does not have the market value assigned, based off of my observational point of view, I can see here that this property is outdated. And if I wanted this property to get sold within the next 30 days on the largest dispositions platform available, which is the MLS, I'd probably have this marketed at maybe $345. I think $345 would be the sweet spot for this particular property, knowing that you're going to do some cosmetic interior work. So I'd say the market value is probably going to be around $345 or $350 for this property. So for us, for the underwriting, we're going to say that the market value is going to be $345. We're going to go to the rental estimate from Zillow, and we can see here that the rental estimate is $2,687 a month. I disagree with that. I think because the property does need cosmetic work, that in order for this property to be rented out within 30 days to a tenant, I think the rental value would probably have to be closer to $2,400 a month. As an investor, you don't want to be having a property vacant after closing for 60 or 90 days because there are bills to pay. You are responsible for the mortgage of this property in a creative finance transaction. And so you want this property to be sold immediately and quickly. So I think for the first year lease agreement, I'd probably have this rented out at $2,400 a month. And then during the second or third year for the lease agreement, either with the existing tenant or a new tenant, we could bump that up to $2,600 a month, as indicated here in Zillow. But for right now, $2,400 is going to be the rent value. $345 is going to be the market value for the property. And so we're going to plug in these numerics into the Jericho software. Again, if you don't have a copy, there will be a link in the video description below. And we're going to plug in $340,000 in our market value for column A, row 3. I'm going to move myself over to the left-hand side of the screen. And we're going to plug in $2,400 for the rental value in column K, row 4. And so we have those two variables now assigned for this property. Now, just like in our last masterclass for seller finance, we need to designate a cash offer for this property. Now, we have the option to either wholesale the property or take it down ourselves. Either method, we want to have equity in this property because we're bringing a substantial amount of cash to closing. Now, because we're assigning the market value of $345, my cash offer percentage is going to be reflected upon the market value of the property, not based off of the list price, because it's currently listed at $372. So we're going to present a cash offer to the seller at, say, maybe 80% of market value. And that 80% market value would equate to $276,000 of the $345 market value that's been assigned to this property. I think $276 is a little bit low for this property. I think we can come up on our cash offer, knowing that we're probably going to have a repair estimate for this property between $15,000 and $20,000 for miscellaneous interior costs. We also have to keep in mind for holding costs for the flipper. If we're going to flip this property back onto the MLS, and we're going to have to account for listing agent fees once the property is flipped. And we're also going to want to make a profit as well. But because we're doing quick math, we're not working backwards from a traditional wholesaler's perspective where you're working at the ARV and working your way down. We have that option here in the Jericho software if you want to take a look at the ARV and you want to work your way backwards in terms of what you think the property would be worth with X amount of dollars invested into it. And if you want to calculate your desirable profit, you have the ability to calculate that here in the Jericho software. That's under the Rehab and Comps tab. But because we're doing quick math here and because we're going to present an initial offer to the seller and we want to see if they're motivated enough for a cash or creative finance offer, we're not looking at comps right now. We'll look at comps at the final underwriting once we have a confirmed yes from the seller that they're ready to move forward. So for this cash offer, 80% of the current market value, $276. I think we can do better than that. Let me try 85% and see what that would look like. It's currently listed at $372. And if we offer the cash offer at $293, I think that's a little high. So I'm going to come down to maybe 82%. And I think that's enough wiggle room there for an investor or wholesaler to have equity in the property to either sign it as well. You'll have enough wiggle room to do any type of miscellaneous repair costs of this property. So I'd say 82%, $282,000 cash for this particular property is where I would be sitting at. So we're roughly $90,000 below the current list price for this property. So if you're below $90,000 to $100,000 of the current list price, you 100% will be able to move this property as a wholesaler. That's what your intentions are. If you're planning on taking it down yourself, then you will have a substantial amount of equity at closing as well, especially since we never even factored in what the ARV value would be. But again, we're not looking at ARV at this moment in time. So our cash offer for this property would be $282,000. That's what I would present with the seller first, get a feel for what kind of feedback it is that they're responding to this offer for. Our sales fee is going to remain at 4%, 3% towards the listing agent commission, 1% towards closing costs. We have approximately $11,000 for total sales costs for this property. The encumbrance on this property, according to PropStream, the encumbrance was $160,000. We're going to plug in $160,000 as the encumbrance. We don't know what the arrears are for this property. That's a conversation that we could have with the listing agent, but that's probably not something that I would bring up until they're truly ready to move forward with one of our two offers. So that means the seller, based off of this cash offer presented to them, they're going to roughly net $111,000 at closing. And in terms of the tax rate, well, let's take a quick look at the MLS and see what it was last bought for. So I'm going to maximize this. Let's go to market value. We can see here that it was bought in 2018 for $167,000. So that is what they bought it for. And they have a cash offer presented to them right now at $282,000. However, something that I just noticed here on PropStream is that the length of ownership is 6 years. And if this is a homestead buyer, then they're not going to be paying any capital gains tax because there's an exemption rule for homestead buyers when they live on a property for more than 2 years. So this seller here is not going to be subject to capital gains tax rates. I'm going to leave that at 0%. We could do a separate video, a separate masterclass for taxation of properties. If that's something you guys are interested in, leave a comment in the video description below. So this is done. Our conventional cash offer is done. We don't need to do anything else to this. Sales price is going to be $282,000. Approximate net at closing is going to be $111,000. Seller's not going to be subject to capital gains tax for this property. Now, for our creative finance transaction, which is what we really want with the seller because we're truly wanting to incentivize the seller for a hybrid transaction, not necessarily a cash transaction, because creative finance will always have a greater value, a greater weight in the real estate world because you're coming to closing with less capital, and then whatever capital is remaining left over, you're making monthly payments on it. So that's a huge benefit to an investor. And because it is a huge benefit to the investor, I'm actually willing to pay more for this property, but based off of its current market value, not based off of its list price. So I'm going to put a cap limit here for 10%. I think that's going to be fair. So that means that based off of the $345,000 current market value for this property, that means I'm willing to pay $380,000 for this property on creative finance terms. Now remember, it's currently listed at $372,000. So the moment that the seller sees that we're willing to pay over list price, that's going to catch their eye. They're going to start asking questions. What is this type of creative finance transaction? Can you tell me more about it? That's what we're trying to do. We're trying to incentivize the seller to take a creative finance transaction as opposed to cash, because again, creative finance will always have a greater value and a greater weight compared to a conventional cash offer. Now, that also means that our higher purchase price needs to be adjusted. In this case, it's already set for us. $380,000 is going to be the maximum purchase price that I'm willing to pay for this property. And you can adjust that value from column G, row 4. So just like in the seller finance masterclass, you would just come into this cell here and you would adjust it. And you're adjusting this cell, which is basically saying that this is the amount of money that I'm willing to pay over the market value. And your higher purchase price wants to be at or below the cap limit. So we're going to go back to $35,000. Our down payment on this property I think I'm going to give the seller $30,000 as a non-refundable down payment. And if they want more of a down payment, then we could have a follow-up conversation with them and see what kind of capital they need up front. Maybe perhaps for moving expenses, or maybe they need a down payment for their next property since they're selling this one. But I'm going to start off at $30,000 because if I can come into this property with less capital up front, that's a huge benefit to you as the wholesaler or as the investor. Our assignment fee, if you plan on assigning this property, you want to stay probably below 12.5%, knowing that there's going to be miscellaneous repairs for this property. It's not turnkey. So I'm going to adjust the assignment fee now to reflect a 12.5% total entry. Okay, so your assignment fee on this property is going to be roughly $12,000. And I'm saying this specifically because the total entry is below 12.5%. And if we need a property, if we see a property needs miscellaneous repairs done to it, I'm going to lower my total entry from 15% to 12.5% total entry, just to allow the investor to have some more wiggle room in terms of the repair costs that are needed. So that takes care of the assignment fee if you plan on assigning it. If you don't plan on assigning it, then just change that value to 0. And we can see here that our seller carryback now is going to be $190,000. And if you double click on the seller, you can see where that numerical value is coming from. So this top portion here is done. There's nothing more that we need to do for the creative finance or the cash. We can now move down to the hybrid section of this calculator. And for the hybrid section, we now need to plug in the estimated loan PITI for this property. So I'm going to pull up PropStream again because we need to take a look at the mortgage and transaction history. We need to take a look at the estimated loan payment. And so the estimated loan payment on this property is $769 and some change. We're just going to round that up to $770. And now that the principal and interest is accounted for, we need to get an approximate for the taxes and the insurance. And so the approximate taxes and insurance is going to be $384 a month for both taxes and insurance. So we'll add this. And again, this is just going to be an approximate. The best way to find out the PITI is to ask for a recent mortgage statement from the seller. But please don't ask that up front because the seller is not going to ask you that. The seller's not going to give you that up front because they don't know who you are and they need to accept your creative finance offer first. Once they accept your creative finance offer, that's when you would have a final underwriting process and you would look at their actual PITI according to the recent mortgage statement. You would do a comparable comp comparison for the rent in that area, and then you would also do a comp comparison for ARV. But because you don't have a yes yet, don't waste your time underwriting that initially. So $1,154 is going to be our estimated PITI. There's no HOA for this property. We're going to minimize the windows here for Zillow, and we're going to plug in 1154 as our monthly cost. This is going to be our monthly cost. We have a section here for yearly cost. There's no second position note, and there's no HOA. So that's going to be left blank. So now that that's taken care of, notice here in the hybrid transaction that the purchase price is set to $380. Very important because in our Jericho software, we're not going to be applying interest. And because we're not applying interest, it's going to be principal-only payments. And the reason being is because we've already agreed to pay 10% over market value. So the $380,000 is including interest, but even though it's not going to be interest on paper. So if I go down to the graph shown below, we can see here that it says total paid over market value is $35,000. Total return gain, this actually needs to be fixed. Looks like the formula for some reason did not auto-populate. I'm going to fix that really quickly. The total return gain is going to be Bear with me for 1 second. Okay, so I just fixed that numerical value. I had to pause the video really quickly because the cell here was stuck for some reason. I couldn't update the cell, but it's fixed now. So the equivalent interest return is going to be 18.42%. That's going to be the equivalent interest return. And we're only paying principal on this property, remember? But because we're paying $35,000 over market value, essentially the $35,000 is going to be the interest that is collected for this property. So the equivalent interest return is basically stating, I'm going to give you $35,000 over the current market value, and your remaining loan amount is going to be $190,000 in this example. And you can double click on the cell here and you can see where the mathematical numerics are coming from. So they're making an 18.42% interest return because we're paying them $35,000 over market value based off of a remaining principal balance of $190,000. So really good return if you look at it in that sense. And now what we need to do is we need to figure out what is the maximum monthly payment that we could give to this seller, knowing that we're going to want a cash flow with, let's say, a 12.5% cash on cash target. The balloon years, I think we're going to bump this up to 7 because there's quite a bit of equity here. So for the seller carryback here, it's $190,000. That's a pretty substantial amount. Let's bump this up to 7 years, which is basically stating that it's going to take me 7 years as the investor to pay off this amount. And when we are at the 7-year mark, or in this case, if I bring out my calculator, if we do 7 times 12 at the 84 months, $156,000 is due to the seller. But this is going to be principal-only payments. The management fee and the repair reserves is going to remain consistent at 10%. That's going to be pretty standard across all the manual underwriting. That's not really something you need to touch unless you are trying to increase your cash flow for whatever reason. Perhaps you are aware that the property is turnkey and doesn't really need to have so much hold back for the repair reserves, or maybe you got in contact with a property management company that's giving you a discount for their services. That is when you would really go in here and change those sell values. But it's more than likely going to be staying at 10% throughout most of your manual underwriting process. So now that we have that squared away and we have a cash from cash target of 12.5%, we're going to click on the macro here for the Jericho software. We're going to figure out what is the maximum monthly payment that we could give to the seller if we are trying to get a 12.5% return on our capital. Well, I can see here that the monthly payment to the seller would be no more than $275 a month. So we are going to take over the existing mortgage payment at $1,154, which is the approximate estimate. We're going to then give the seller $274 a month for 7 years, and the total amount paid on this property for a hybrid transaction is going to be $380,000. So again, just like with the seller finance calculator, we are controlling how much money the seller is receiving in the back end. So I already know ahead of time that I am not going to be paying more than $380,000 to the seller for this type of transaction because we are doing principal-only payments, no interest involved. And another reason why we're not paying interest on the second position note is because it's not desirable as an investor to have 2 mortgage payments with 2 separate interest values. And this is more with a psychological effect. Interest as a whole is not really seen as a benefit to the investor other than it being a tax write-off, but we're already getting a pretty substantial tax write-off with the first position note. And then there's going to be other tax incentives with this property because real estate has a ton of tax incentives. So we really don't need another tax incentive for a second position note. So it's just better to just do principal only payments and being able to pay down that principal amount at a quicker pace, which would be super helpful in a transaction such as this, which is a hybrid transaction. So that's really the main reason why we don't include interest in the hybrid transaction. Also knowing that we have intentionally given the seller $35,000 over the market value, which technically is going to be a interest return of 18.4% based off of the principal loan amount of $190,000. So that basically is their interest. So this takes care of the hybrid transaction. Pretty standard. If you have any questions at all, leave a comment in the video description below. And I hope this was helpful. We're pretty much have concluded our masterclass video series. If you'd like to see more of these videos, leave a comment in the video description as well. And perhaps we could do more masterclass sessions moving forward. So thank you for your time. Take care, and I'll see you on the next video.